It may not feel like it, but the S&P 500 index, the benchmark for US stocks, has just hit another new high this year. Number 30 to be exact. We're in the middle of a fantastic bull market, and yet there's still a lot of nervous energy out there. And it's true. Bull markets don't last forever. And spotting when risks emerge that may derail the bull run is pretty crucial when it comes to tactical asset allocation, which is what my team does. So, in today's episode, we're diving deeper into whether there are telltale signs that a bull market is nearing its end and what steps we can take to stay ahead of the curve. I'm Philip Petursson, Chief Investment Strategist at IG Wealth Management. Join me each week as we discuss the trends dominating the investment landscape. It's the week of June 17th, so listen on as we navigate the living market. Bull markets can give us a sense of optimism about the economy, sometimes overly optimistic. And when it feels like nothing can go wrong, well, history has taught me that that's probably the most worrying sign you can find, especially when it seems every investment shop on the street is tripping over themselves to upgrade their market targets for year end. Now let's forget about how we feel for a moment and consider what we see. The big question is, how do we know when the downside risks have increased? Today, let's look at some of the key indicators we pay attention to in order to mitigate these risks. First, let's take a step back and look at history. Bull markets have ended in various ways, sometimes abruptly, like the crash of 1987, and sometimes gradually, like the slow, painful decline that was a tech wreck that lasted between 2000 and 2003. Historically, there is one major signpost that precedes the end of a bull market, and that is a recession. Truth be told, it's impossible to predict a market top. Now, we don't do that, nor even try to attempt to do that. Rather, what we do is identify the risks to the upside and down and position accordingly. On our risk checklist right now, we see some yellow lights popping up, some are still green, even improving, and some are red. So what are these key indicators? Well, here are some of our favorites, or more important ones that we pay attention to. First is the U.S. yield curve. Now, what a yield curve is really the positioning of interest rates on a short-term maturity bond versus a longer-term maturity bond. And when a yield curve is inverted, that means long-term interest rates are shorter or lower than short-term interest rates. An inverted yield curve like the one we've had since July of 2022 has preceded a recession every single time in the last 50 years. Now, a recession follows the inversion of the yield curve on average about 11 months. But the duration to a recession has been as long as 22 months, and that's roughly where we are right now. So we're likely to potentially see an inverted yield curve much longer before we see a recession. Now, this factor alone is not enough to call for a recession, and those who used it to get out of the markets in July of 2022 have missed a phenomenal bull run. Now, let's look at manufacturing activity. Right now in the United States, it's giving us mixed signals. It's teetering in the neutral to slightly negative. We're not seeing any expansion out there, but nor are we seeing a significant contraction. When we look at some of the leading indicators to manufacturing in the United States, namely the difference between new orders and inventories, it suggests that the potential is for further weakness or some weakness ahead in activity in the coming months. So here the risks are increasing. But on its own, it doesn't tell us enough. The big one right now is unemployment, and here's why. As long as people have jobs, they will spend. As long as people spend, the economy will grow. Consumption is a very big part of the U.S. economy, and in the end, the consumer will decide the fate of the economy. Unemployment has been creeping up in both Canada and the United States. Now, the actual numbers aren't terrible yet. Unemployment in the U.S. is only 4%. But the trend isn't encouraging. On balance, the economic indicators are telling us to pay attention. So, if the economy isn't quite as robust as we would like, what about stocks? Are they at least offering good value? Well, it depends on your measuring stick. The price-to-earnings ratio for the S&P 500 is somewhat elevated, but not dramatically so. It's certainly not at the same level of the market top of 2021 or 1987 or 1990 or March of 2000. And valuation is a poor predictor of short-term performance. The S&P 500's current trailing price-to-earnings ratio is 24 times. Now, there's an old valuation metric that I like to use that's called the rule of 20. It suggests that the fair value of the S&P 500 index is when the trailing PE ratio plus inflation adds to 20. Now, the current number is 27. Not disastrous, but definitely not a bargain. Though that metric has been improving lately. That combination of those two numbers has actually been coming down. But we're in a funny market right now, which is very heavily dominated by just a few companies. If we remove the impact of these big companies and look at the index on an equal weighted basis, well, suddenly the PE ratio drops into the mid-teens. Now, it's not dirt cheap, but it is much more attractive. Right now, people worry about the narrow market breadth. What that means is only a handful of stocks have really been contributing to the gains on the S&P 500 this year, similar to what we saw in 2023. Now, while it might seem unhealthy for only a few stocks to drive market gains, it doesn't necessarily predict a market peak. Historically, mega cap leadership years were followed by further gains nearly 75% of the time. So, can the equity markets continue to push higher? Well, yes, but let's keep our expectations in check. Not all indicators are created equal. Some might sound alarming, but don't actually provide useful information, while others demand our attention. Now, here's the more important question. When do we sell? Emotional selling is the worst thing you can do. We would say that it isn't about selling or trying to time it perfectly. That's impossible again. Rather, as we've said in the past, it's about asset allocation and managing risks rather than trying to predict them. For instance, historical data shows that the odds are firmly in your favor by remaining invested in the market over the long term. The probability of a loss over a one-day holding period is roughly equivalent to a coin flip. But this probability improves significantly the longer the holding period. For the S&P 500, holding periods of 3, 5, and 10 years have historically shown much lower probabilities of loss the further out you go. Holding periods of 5 years, for example, the S&P 500 has had negative returns 1 out of 10 times. Holding periods of 10 years, and it drops to 1 out of 20. Time is on your side. So, while it's important to be aware of the risks, trying to time the market rarely works out. Diversification and a long-term perspective are still your best bets. I'm Philip Petursson, and you've been listening to the Living Markets Podcast. If you've enjoyed this podcast, please take a moment to rate it or share it with colleagues and friends. It will help other like-minded individuals find us. Thanks for listening.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purpose, and IG Wealth Management is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from expressed herein. Our views are subject to change based on market conditions. Commissions, fees, and expenses may be associated with mutual fund investments. Read the prospectus before investing. Mutual funds are not guaranteed, values change frequently, and past performance may not be repeated.